gentlemen.
Good to go.
Thank you. We call the order of the Lawrence County Retirement Board meeting on August 12th, 2025. Dave, you want to lead us in the pledge of allegiance and on the sun?
Pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Mike, we will roll call.
Yes. Controller Prescott.
Here.
Treasurer Poe.
Present.
Commissioner Sonato. Commissioner Kennedy.
Here.
Commissioner Vogler.
Do we really explain? We have a recording and we have a live stream here as usual. Next is public comments, and we have nobody in the public, so we can go to the minutes.
I'll make a motion to approve the minutes of last meeting.
Second.
We will roll call, Ron?
Controller Prescott.
Yes.
Treasurer Poe.
Yes.
Commissioner Kennedy.
Yes.
Motion granted.
Carried.
Thank you.
Now we're up to Sarah. We're not messing around today.
Okay, so fast.
Yes.
Okay,
Whatever you want to do.
okay. Good morning. Nice to see everybody. Let's just hop to exhibit 2. We'll start right in on how the market is doing. So that's page 10. And we've had a lot of news and it keeps changing because it keeps, news is coming out every single week, every single day. So we look at what happened in the second quarter and we saw GDP growth actually rebounded in the second quarter to 3%. Net exports were a large contributor to growth, and it's a reversal from the first quarter, adding 5%. And the consumer spending, they are driving still the market. Despite debt or anything else, the consumer is still out there spending. And even with how we're seeing inflation, we know inflation's struggling to come down now. We knew that tariffs were the big, thing that was going on in the media. We know that happened in April, actually tanked the market. We almost hit a bear market. It's then come back. We look at the inventory of goods, and inventory of goods have surged 27 billion in June alone because people are saying might as well buy it in now and stockpile it, and that also raises prices. And that's when the Fed talks about looking at that. They know that these tariffs that come in. Currently, the tariff is 18.3% that you're paying, and that has been the highest since the 1930s. So we are really paying high in tariffs. So we've kind of, if it goes up 12%, and they're saying, they're going to put tariffs of 35%, the 18 is already there. So yes, it's going to make things more expensive. The concern on tariffs, as we know, is one of the large concerns is Canada. If that sticks, we get 24% of our lumber from Canada, which will then go into home building, which will have a large effect on the market. And you can see below on page 10, the inventory of goods, just how it spiked. And that's, all driven by the media and tariffs. And then we look, it comes down to July 1st. It remains above levels from the earlier July, but only by 4.2%. We go to page 11 and we look at the change in non-US, non-farm payrolls. We know unemployment is still kind of was missed a little bit. But we know that with that, you can look at who's employed. Look, education, other government, ex-education in 2024, and healthcare. So healthcare in 2023 and 2024 were the big drivers, and then year to date, we're looking at education and healthcare were the drivers of unemployment. And the June non-farm payrolls showed a gain of 147,000 jobs, which exceeded expectations. So what does that mean? We go to the bottom of page 11 and we talk about the Fed. The Fed's had an interesting thing. You remember last year we thought 5 cuts, and then, they didn't. Then finally in September, they started cutting, but not what the market expected. We go into this market, we're thinking 2 to 4 cuts. We know that March, we weren't gonna think of any, they came out, they said they're not gonna cut. Then we saw the market have a huge dip, we thought, all right, now they're gonna cut. Well, they're looking at inflation, and they're looking at tariffs, and they're looking that consumer spending just keeps going. And so when you look at inflation at the 2.2%, 2.4% where it is, they want it down to 2, but you take government spending and what the government's putting in, inflation actually targets over 8% of where you're going. So now the Fed came out and they said no change again for lowering rate, but this time only 9 voted, 2 abstained from that vote. And we know the chair ends at the end of this year, so that could be, almost like it's a lane in setting policy for the years driving ahead. There are some people out there, economists, that believe there will not be a cut till 2026. The market's still pricing in 2 cuts now. We turn the page and we talk about what's been going on in the economic data outside of the U.S. We saw that the European Central Bank cut rates for the 8th time over the past 2 years, lowering the deposit facility rate to 2%. So that is hopefully with the $500 billion that Germany put in at the beginning of the year, that they're hoping that is going to really make momentum for some growth on there. Despite its rate cutting, the euro continued to appreciate in the second quarter, reaching the strongest level relative to the US dollar in nearly 4 years. So when we have a weaker dollar, we know that international and global stocks may suffer from that. We go look at global asset class performance at bottom page 13. Unbelievable rebound. Remember last quarter we were negative. We rebounded. Equities were up 11%. U.S. equities, non-U.S. equities are up 11.8%, emerging markets up 12%. And so we talk about that, we look at commodities. Commodities were down in the decline in oil prices and other energy-related commodities. But you can see even bonds for the trailing 12 months are up 6.1%. So that is something different. We start seeing the bond market kind of hold its own, where it's been very limited in returns. We look at U.S. REITs, they were down, but for the trailing 12 months, they were up 9.2%. If we turn the page, and I think this is what happened, we entered a bear market in early April, tariff concerns and a staggering historic rally of all time. In fact, the S&P 500 index saw the fastest recovery, 55 trading days in the last 70 years of 15%. So we saw an extreme amount of volatility. And while we like those gains, we also know that those were very concentrated gains. We still talk about the Mega 7, how that's affecting us in NVIDIA. Is a good example. Their market cap is the entire market cap of Berkshire 2500. So, there's got to be something. When we look at performance and we look at our managers compared to the benchmark, we have to really keep in mind that this market still is being driven. Hopefully, the concentration will kind of die out in the next couple of years. The problem with the concentrated market, you get one bad missed earnings from these companies, they're going to drive that market down. But you still want to be completely diversified. And we look at AI. We know last quarter AI, there's a Chinese AI coming up that could be much cheaper than some of the companies here. We look at what's happening there. Apple is putting $1 billion into spending here. We're starting to see companies putting more money into the United States. Not because they want to be U.S. based, but because it's a good idea that these tariffs stick. So, it's going to be good for the economy if they're hiring. We saw Microsoft lay off 3% of their entire staff. Part of that could be, actually, I think it's AI, but, they have learned to replace some of those jobs. But, we start seeing that happen, we know, that down the road, it's gonna be a little bit harder on the market. We look at page 15, and I think this really says it all. According to that top graph, according to the Bank of America, the S&P 500 index ended second quarter at the cusp of its seventh breakout since 1990. The current bull market, however, is the narrowest on the list. So look at 6/26/2025, it's only 22 stocks hit an all-time high. So it's not the entire market that is coming back, it's those stocks really moving that. And we also are seeing that the top 10 companies in the S&P now account for a record 38% of market cap and 30% of the index profits. While the latter is also on record, the spread between market cap and profit remains one of the widest seen over the past 40 years. So, the profit, as we know, is going to start going down because it's, they've gained that. So the disconnect is also evident in valuations, which shows indices comprised of the largest stocks trading well above their historical means. And then what that means is that we've got growth again leading the way. We've taken value tilt that's helped you move down markets and up markets. You'll be lagging a little bit behind, but when we look out 10 years annual months, that's really the number you want to meet your actuarial report. 7%, actually you're lower than 7%, but we look to meet 7.5% to 7%. If you've done that, you're doing good. Any questions on the market? All right, let's go to the next section. We'll go to page 22. Market value as of June 30th was $109 million, with a gain in the second quarter of 6.9. You returned 6.7 through end of July. You're at about 7.5%. 1 year ending 6/30, you had a return of 11.2%, net investment gain of 11.3, and since inception, you've annualized 7.9% with a net investment gain of $72.2 million. And that net is net of our fee, net of all the manager's fees. So that's your net fee when we get those. Positive attribution for the quarter was Dodge & Cox and MFS low volatility. And your real estate manager, Clarion, did very well in this market. And then Eaton Vance, we'll talk a little bit about Eaton Vance. Eaton Vance, it's interesting, has just had a really tough time in this market. It's versus their benchmark, but they're still working the way we want them to. They have not changed anything. So we're just kind of sitting back and watching them, but we're still very comfortable with them. Global Equity Composite. Last quarter, what we did was we split Artisan down to 2.5, and we had a WCM. And then this quarter, WCM CIT, we enrolled you in the CIT, which lowered costs. By the end of this quarter in June, we said enough with Artisan and we fired them outright because they had a portfolio manager. So they were struggling with performance, and for years they've done a very nice job. Then we started to see that they deviated from where we wanted their returns and how they were managing money to fit with other managers in the global arena. And then they called us and said, they've lost some of their portfolio management team. So we made the decision to go to WCM instead of trying to keep those two in there, which we thought would be well together, but it's not worth it taking the performance hit. Any questions so far? All right, let's go to page 28 and 29 really quickly. 27 percentile, and you were at the top first quartile. 5 years, you were in the top first quartile. 3 years, you were in the first top quartile. 1 year, you were in the first quartile, and then you're a little bit below it year to date. You were in the median. And that is probably because of a lot of the volatility. It's probably because growth really drove the market in the last 2 quarters. But you have done very well, net of fees, compared to all the public DB plans that participate in this. And it's not all of ours. It's across the board nationally. Right, and then we will go to, let's go to page 32, we'll talk about performance. As we talked about, year to date, your equity composite did 8.8. We talk about the US equity composite, we look at Eaton Vance, Atlantic Smith. They have struggled this quarter, so you can see they were 3.4 versus 8.6. They were negative year to date when the market was positive. But then we go to 3 years, 11.6 versus 11.3. Remember, keeping this year and that performance in there, it's still where it should be. And then we look at 5 years annualized, 2.3 versus 11.4. And that's the number you really want to look at. Because in those 5 years, we've seen an incredibly volatile market, very concentrated market. We've seen a double-digit negative year market for equity. So they have held their own. It's just where they are right now and where their benchmark is. So, just keep in mind, we're very comfortable with that. If we go to global, you can see Dodge and Cox, that's page 33, did 8.1 versus 5.8. Year to date, it did 14.7 versus 10.9. Artisan is gone, but you can see it just did not come back at all. And then we put WCM Quality Global Growth in March. And that actually is, since we put it in March, it's done 10.2 versus 9.3, and it was 17% for the quarter. Any questions so far? Non-US equities, we added them last April, DFA, that's at the bottom of page 4. That's your non-US equities, your emerging markets, which have done well. Did 12.7 versus 12, year to date 13.9 versus 15.3. And then the last year, in a bit, 15.3 versus 16.5, and we're comfortable with that performance. It's not always going to be a home run, but a lot of times we put these managers in who we've had for a very long time to protect us in the down market. Page 34, you can see real estate actually had a nice quarter. Clarion did 1.5 versus 0.8. Year to date, it did 2.2. And for the trailing 12 months, it's done 4.0 versus 2.7. You look at TA Realty, did 0.6 versus 0.8. Year to date, 2.3 versus 1.7. And then 3 years, negative 3.5 versus the market of negative 6.2. And since inception, they were positive 2.8 versus the market of negative 10 basis points. So they've done very well. And we know after COVID, real estate got absolutely hammered for a while. Then they did very well when bonds and equities weren't doing well. But what happened with real estate is they had to kind of basically write off their office buildings. They still own them. They're still renting them out. They're still collecting a lease, but their value is really kind of, they said, okay, that's it. We'll take the income from them, but we're going to just write it off, take the hit in performance, they still own it, and move on. And we can see a lot of those office buildings are now becoming apartment buildings. Look at downtown Pittsburgh. So that has changed over. Rentals are really driving real estate, and the Fed, if the Fed drops a couple times in the next 12 months, it'll be easier for them to buy more in the portfolios. You are a value core real estate investment, meaning that you are not looking at a manager to go buy 100 million and sell it for 200 million. You're looking at a manager that is very low in the leverage, that is 90 to 95% rented out, leased out, occupancy. So that way it will produce a nice dividend, and it's supposed to be 5 to 7% annualized for the next 10 years. We funded that with fixed income, and then funded some of it with equity and took the volatility out of the equity portfolio.